Welcome to StockOdds Odds End. We're getting ready for the trading week starting on the 20th. We're post Super Bowl, post Valentine's, post President's Day. It's time to get serious. Hey, Rob, how's it going?
Not too bad, but we do have a shortened week. It's a 4-day week, so everything's compressed again. So hope everyone had a good long weekend, and as Dave said, ready to rock and roll here. So we're going to go through a few things and hopefully provide a little bit of insights that can help you navigate this upcoming week. So first we'll review Friday. This was what the SPY did. We had the January PPI and housing starts. It was a fairly hot number that came out again, kind of similar to what we had on Tuesday with the hot CPI numbers. And we did knock us right down because we were elevated before that. So it knocked us down through the previous close and ended up, trying to bounce a little bit here, but didn't get back up over the previous close. So if you were watching pre-market, that was a bit of a tell. And of course, you can still allow it to close the gap since it's opening slightly below. It did spike just briefly for 1 minute. Didn't make it through the previous close and then rolled over. We have an opening crossover move and down it went with high signal. So what kind of turned it was we've got the Michigan sentiment where it comes out actually 5 minutes before. So you can see this right here, and then right at the top of the hour we turned. So this, I would call this whole thing Michigan sentiment, which actually had a positive spin to it. And it did help bring the market back. And so we did end up filling the gap here by about 11:30 or so. And we did have, again, some high signal on the way up too. So if you guys are, watching the market during the day, you gotta say, is it choppy sideways, whipsawy, or is it moving somewhere with good signal to noise ratio? That's what we're trying to tap into. We got back up here to the previous close, and then we chopped sideways along that. Again, fell back down and back up again to retest the pre-market highs and failed to break higher and rolled back over. And again, really high signal all the way down to close near the low of the day. So that was the situation on Friday. And it was an expiration Friday as well. So there's a lot of extra stuff going on. We're also in front of a long weekend. So, the bulls wanted to have their session, the bears wanted to have theirs, and end up being kind of a tug of war with some chop here. So this is the 15-minute chart of the week. And put in the Friday before, which did rally. And then we had a continuation of that on the Monday. And then when Tuesday came around, again, that hot CPI numbers knocked us down quite significantly. But if you were paying attention to the way things unfolded, in the last 45 minutes of the day, we had a nice hammer, and so the price rejection on that 15-minute, and then we rallied and broke up for the last 30 minutes here. And so that was a tell. And then after market, which I don't show here, but that continued to build. And so it wasn't a surprise that we had an elevated open on the Wednesday. Pulled back, more of a choppy day, but kind of held its own okay. And then we built on that for Thursday, and then we came into, again, hot numbers here. It pulled us back, but not as dramatically as what we saw here. So market gave it a pass, I think, and we'll see what transpires next week after this close. So definitely closed below Monday's open. So for the week, it was a down session from the open to the close of the week. So here's the SPY daily. You can see where we're sitting here. So it was an expanded trading range session, but by only a few cents on the SPY ETF itself. Few cents in both directions. It was a expanded trading range session. But definitely, from having a streak walking up the upper Bollinger Band, those CPI numbers did knock knock us down, took a little bit of wind out of the sails of the market, and but we did recover, and not a bad situation for the bulls here, as we managed to claw our way back. Okay. Here's the Qs. Also suffered from the CPI on Tuesday. SPY, Qs. There's the Dow Jones. So inside day on that one, on the diamonds, inside day. Here's the Russell. So we had that really great streak on the Russell, and then on Tuesday, it pretty much erased almost 3 days of it, and then built itself back up. So a lot of volatility in the Russell. It's this, contention with, is there growth? Are we getting back to business as usual soon? Are the interest rates going to, be favorable for us small caps? And by the way, we want to catch up to all the party that's been going on in this, S&P 500, the NASDAQ 100, and even the Dow. We want to, catch up to that. So it certainly came alive here earlier in February. So just watch the volatility if you're in that area playing small caps. Here's the sector performances for Friday and the week. Basic materials did the best on Friday, healthcare next. Communication services was down in the dumps, largely because of Google. You can see that also here for the week. So communication services and technology. So we had a lot of profit taking in these bottom three sectors: cyclical, technology, and communication services. Lots of profit taking and some concerns about an overheated market in light of what's going on with interest rates and the dollar and everything like that. But energy did really well for the week, and we'll take a little closer look at that a bit later. Basic materials came in second. So the dollar had been elevated, and even though the numbers kind of supported the long dollar trade, there was a bit of a pullback, and I think people were kind of thinking, well, the news is out now, and the dollar could go a little bit more, but it's a good posturing for how discounted commodities actually are relative to the rest of the market. So I think that was transpiring there. Let's look at our sector performance ETFs, the sector ETFs, sector spiders we call them. And we have XLE at 2.71 and XLB at 2.44, and XLK down in the dumps at 2.54, followed by the Qs here. And you notice that on the broader level, the communications, you saw it with the broader market down substantially, and with the sector spider itself, not as much. So that's the difference between why I showed these two different charts here. This is a broader market, and this is just the sector spiders, and then the four horsemen here: diamonds, IWM, Qs, and SPY. Okay. Relative volumes, all hanging in there, close to 1. Nothing major to mention there. Volumes are okay. Remember to check your weekly versus monthly volatilities and know what you're dealing with when you're using these or trading these sector spiders or using them to hedge with. Map of the market for Friday. You can see Meta having a bad day, Adobe having a really bad day, Airbnb, Nike, some of the other discretionary. In the healthcare, look at the difference between Lilly and Gilead. Real estate, again, same thing. So a lot of the real underperformers are more related to earnings or some specific news on them. In the semiconductors, we have a little pocket of strength here in AMAT, CLAC, and LRCX. And NVIDIA held up pretty well. But it's been in a bit of a consolidation phase. We'll look at that a little bit more. And then this is for the week. you can see Google getting shellacked and Adobe getting shellacked. Okay. Snowflake and Deere getting hit hard there. Here's a daily chart of NVIDIA. So this is the consolidation I was speaking of right up here. There's still a pretty big reluctance to sell it ahead of earnings. But, again, I would recommend that earnings are one of those wild cards. We don't know how it's going to react, whether it will pop up after hours and, do another spike and then pull back from there and actually be down the next day, or whether there'll be a miss on what's being expected and drop. But this is really important to mention because NVIDIA, whatever happens here, could be a catalyst for the sector, obviously, but also for the market, especially technologies, because there's such a big weighting for the S&P 500 and the NASDAQ in the technology space. So it can be something that really does impact the market. So keep that in mind. It's not just, it's another stock having earnings. This has been such a driver and, crowded trade perhaps. So right now it's a bit of consolidation, a little bit of profit taking, which I wouldn't blame people if they were already in it to sell some of their position, half their position or whatever ahead of an earnings event. I wouldn't blame them. Taking a gamble and saying, hey, I'm going to buy it for earnings or I'm going to short it for earnings, that would be an approach that you probably don't want to do. Because again, even if something beats earnings doesn't mean it's going to go up. And just because it misses earnings doesn't mean it's going to go down. We don't know how the market will respond. We could possibly do enough homework and research to get a very good probability and insight into what they'll report, but we still don't know what the market will do as the report comes out. I think it'll be, definitely impactful and not only the sector, but also impact the market, okay? Here's the daily chart of Google. As you know, it had a bad week here and pulling back, but look where it's sitting here, getting pretty, not really on the RSI, not really super oversold, but still could have some room to go lower. We'll be definitely looking at this point that we hit here earlier in February to see if it holds up at that level. And if it did, that would probably be a penetration of the lower band as well, and we might get an oversold reading on the RSI. We'd have to go to StockOdds, of course, and look at what the probability is for Google over the next day, the next 3 days, that kind of thing, but certainly discounted. And we still have this gap that didn't quite get filled up here. So gap down, and we made an attempt to fill it, but it never did. Okay, here's the US dollar. You can see that pullback that we had in spite of the hot CPI and the hot PPI and the fact that we're not anticipating as aggressive of cuts and possibly, the Fed won't do anything until July, as I've mentioned before. So the dollar pulled back, and that's the support that you saw underneath basic materials and to some degree energy as well, because both are priced in US dollars. So this is back to our consolidation. This is an important point. We could break back to the upside again or to the downside. Now, I just wanted to show up the Bitcoin versus US dollar because we're coming towards the Bitcoin halving event, and crypto has been a lot more in focus. And we can start to use this also for an indicator again. When it was in this, consolidation phase here, or, not really making any new strides and kind of just trading in that range, it wasn't as much of an indicator. But as it broke out in November and started climbing again, it's been more useful as a leading indicator because it trades 24/7 and it kind of showcases whether there's a risk appetite, and it's going to play into the technology stocks for sure. And you also have to know which symbols you trade are exposed. I mean, it's one thing if you go and trade Mara, which is a miner. It's another thing to trade, MicroStrategy, which is a holder or a hodler. So you got to know what you're trading and how it responds to the price of Bitcoin. But it's definitely been on a tear, and I fully expect that ahead of a key event. Doesn't mean it's going to continue to go up after the key event. Here's Ethereum, where 95% of the world's apps are built, crypto apps and so on are built on Ethereum. It's also been grinding up, following Bitcoin to some degree, but also perhaps, still able to be a little bit insulated to that because of its use case, not so much as a currency, but as a necessary product in terms of settling gas and things that happen when you're moving crypto on chain or off chain or whatever you're doing with it. There's gas to pay. A lot of times Ethereum is used to settle. So anyway, keep that in mind. It marches to the beat of its own drummer to some degree, but it's still very connected to what's going on in Bitcoin. 10-year note, you can see that pulling back, which means that yields have been rising. Okay, so yields were selling off here, and then they started rising again. Little spike of hope, and then we've since February hit, we've been pulling back. So yields are rising. Here's this West Texas crude. You can see that we're at a 3-month high here. So there's the $80 of resistance there coming into play again. We are now over the 200-day moving average. Once again, we've had a cross of the 20 over the 50, and the 20 may come and cross this 200. So the question is, fourth time knocking on the door, will that be the charm? Will it pop through and get through that 80 and move on up? We still got problems in the Red Sea and elsewhere in the world. So energy is, not down and out completely. We had a good week on it last week. There's the XLE. You can see it popped up really well on the daily on Thursday and then held its own there on Friday. So it's got a challenge. XLE's got to definitely challenge the 87 level. Okay. All right, Dave, what do you got here?
Yeah, so Tuesday we have U.S. leading economic indicators. And Wednesday, there's something interesting. The Fed minutes are from January FOMC meeting are being released 2 p.m. on Wednesday. And again, there's a smattering of Fed speak here and there on Wednesday and also on Thursday. And then Thursday, we get the PMI numbers for services and manufacturing. That gives us insight as to economic health of the country and existing home sales. That's nice to know too. So the themes are Fed speak, FOMC minutes on Wednesday. But I think the bigger driver is going to be some of the earnings. So on Tuesday, we have a couple big earnings. We've got Home Depot and Walmart. So again, that's going to show us how the consumer is holding up and what's happening with the housing market in terms of remodels and whatnot, how people are spending. Walmart shows us how the average consumer is spending on groceries and whatnot. But the big one is on Wednesday, NVIDIA. Like Rob said, that's a key driver for technology, but also for the market itself.
Well, I mean, the minutes, we've seen them to move the market before, right? We've seen the minutes to move the market, so be aware of that. Even though it's like, well, it's kind of a repeat of what we saw in the February meeting, but I've witnessed many events where the minutes actually move the market. So make sure you set your clock for that. And the economic news can always do stuff, but Dave's right. There is a lot of Fed speak, and sometimes they, reinforce Powell's messaging, and sometimes they actually say something that kind of might be a bit against it, So any of these Fed speakers could set the tone. Now, today's Monday. It's a holiday, but it's still a merger Monday. So we've got Capital One buying Discovery Financial. And so they're paying a 26% premium over Friday's close. And COF shareholders will own 60% of the combined company. And it's a share deal, pure shares. So this is the factor that you have to use. So 1.0192 of COF for 1 of DFS. So that makes it 137.23 times 1.0192 equals 110.49. So that's 20, based on Friday's closing prices, the spread price should be 29.37. So let's see where it opens on Tuesday morning. And it'll be far less than 29.32, because that's what it would be based on Friday's close. But you can see that it doesn't appear that there was too much leak of information. Now, Discovery has been a bit stronger. So I would put my blow-up risk on Discovery down at the 105 level here, where it was stable before this recent run. There may be a little bit of leak of information here recently, although the market was doing okay. This was stronger than Capital One. So normally when you get a stock merger, if they're paying a big premium, which it's 26%, it's not like crazy, but normally Capital One should move down, be under pressure a little bit as the acquirer, and Discovery would jump, a good chunk of that 29.37, right? So Discovery will pop up. Now, it could be that Capital One also rises a little bit, and that's going to put a bit of stress on that ratio, on that spread number. But it's happened before as well. Anyway, when you get mergers, it can be positive for the market. It can support the market overall, and especially in financials, because there's a lot of financials in the S&P 500, and so it could support some others. Dave, you have any ideas of Me Too type trades where some of the companies go, hey, I want to be acquired too, and then they start running up?
Yeah, it could bring a lot of excitement into the lower mid cap credit services companies like Ally Financial, Synchrony, SoFi, OneMain. So things that are kind of middle market cap, not the Visas and MasterCards, but there may be a bit of pop in those stocks because they could be buyout candidates. So
true, and you also have quite a bit of regional bank exposure in the Russell, and so those could also. I think overall there's some serious concerns in regional banking, but this might be a temporary boost on the back of something like this. So and then it can also play into how the Russell performs on Monday, or even for this week. Or sorry, Tuesday, or even for this week. So that's that. Anyway, pure merger deals you can trade. So you trade this spread number, which again will change. It might be somewhere around $3 to $4 of spread on Tuesday. We'll see where it opens and how it performs. And why it would not be zero is because there's still time. This won't close until the fourth quarter this year or the first quarter of 2025. So there's time element, there's regulatory approval element, shareholder approval, all kinds of things. So at this point, it's a tentative offer that's subject to approvals, and so that's why the spread price won't go to zero right away. Ultimately, when the merger is consummated, it does go to zero. Okay. Other items and food for thought. So the state media reported over the weekend that about 474 million domestic tourist trips were made during the 8-day holiday, Chinese New Year, up 19% from the same period in 2019. So it's up pre, COVID even. And so total tourism spending climbed 8%. So this can be favorable to some of the Chinese companies and in the market overall. So just keep that in mind. That could also play into how Russell performs, because there seems to be some correlation there between Chinese stocks and the Russell. There's a truckers' boycott of New York City and potentially other Democratic cities. So don't know how big this is going to get, but something of note anyway. Could be very disruptive. China is selling U.S. Treasuries. They've been going about it orderly, but they have dropped their ownership over the previous number of years, and that might continue. And there's some other countries starting to also sell Treasuries. So we're not in a huge U.S. Treasury demand cycle. It seems the opposite. We're in countries unloading a bit for domestic reasons, perhaps, or for lack of confidence in U.S. politics reasons. I'm not sure, but that's definitely happening. You guys can look into that more. U.S. debt is more and more in focus all the time. You can hear the narrative, and it's definitely becoming a political issue as well. And oil is steady at the 3 months highs. We talked about that earlier. Fourth challenge of resistance could be a success. And with that, we will sign off. You guys have a good one.
Good luck.
Trading.